Good morning. Welcome to Stock Market Today. It is Thursday, August 22nd, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas for you to consider in your inbox every trading day before the market opened. So U.S. equities were higher in Wednesday's trading. Strength was concentrated in consumer discretionary and tech sectors, though all finished higher on the day. Treasuries were weaker with the curve flattening. The 210 segment actually inverted again yesterday afternoon. The dollar was stronger on the major crosses. Gold finished unchanged. WTI crude down 80 basis points, reversing early strength despite a larger than expected U.S. inventory draws. We get to the desk this morning. Futures are down 20 basis points after that solid string of gains yesterday. Asian markets were mixed overnight. European markets are on the defensive following yesterday's rally. Treasuries are mixed. Dollar is weaker versus the yen, but stronger versus the euro. Gold up 10 bips. WTI crude giving a little back here today, down 30 basis points to get us started on a Thursday morning. And really what we're seeing here is the back and forth trading within a wide range continuing to play out. We've been highlighting the support and resistance levels, 2,800 to 2,850, the support zone, which now includes the rising 200-day moving average. Resistance still in the area between 2,900 and 2,950. So for all intents and purposes, we are in the resistance zone, probably stronger at 2,950 as it incorporates these tops from last fall and early spring. Above that, you start dealing with round numbers at the 3,000 level. RSI remains below 50, so even on these up days, RSI can't get above 50. RSI can't push into bullish ranges. RSI can't give us a bullish momentum shift. Hanging out in the middle of the range kind of lines up with what we're seeing. Range-bound trading for the market between these levels that we've now been highlighting and which the market has been respecting for about 2 weeks now, maybe even more. Chaikin money flow is bullish, but now turning lower. Yesterday, we started to highlight the series of lower highs, just something to keep in mind from a longer-term trend perspective. So indicators are mixed. Market is choppy, and that remains the case. And as we said, after a rally yesterday, S&P 500 futures are giving some back here this morning. Your market in a minute now. What are we talking about? In our note to Chaikin Analytics clients, seesaw trading continues in the range as the majors move higher on Wednesday. Breadth metrics improve, but have yet to tip a breakout. We'll talk about what that means in a second. ESG is a growing investment theme. I get a lot of questions about this. How to, invest in the sustainability theme, the socially conscious investing, ESG investing. So I did some work and found an interesting ETF on which Chaikin Analytics has a bullish, call it bullish, ETF power gauge rating. Bond proxies look stretched to the upside in the near term. Interesting bubble chart that we'll take a look at a little bit later in the show, included in the note today. And futures point to a slightly lower open, as I said. Power bar ratios for the major indices remain mixed at best. Dow, 3-1 bearish to bulls. 9 bearish or very bearish stocks, 3 bullish or very bullish stocks, despite a 90 basis point move to the upside yesterday. S&P 500 tax on 80 bips, 86 bulls, 102 bears. NASDAQ even at 22 apiece, bulls to bears, following their 88 basis point rise yesterday. Small caps are an inline performer, skewed bullish. Still, 405 to 347. Bonds downtick slightly. Discretionary big outperformer. Lowe's and Target, big moves to the upside following their earnings announcements yesterday. We'll take a look at movers and shakers a little bit later in the show. According to the Chaikin Power Bar, small cap stocks remain somewhat more bullish than large cap stocks, and the major markets are mixed. Our stock of the day is actually one that's been in the news quite a bit lately. We've been highlighting it on both sides of advances and decliners, it seems. DaVita, DVA, medical care stock, group that we've warmed to recently. Closed at 56.58, up 1.2% yesterday, so a nice outperformer on the day. Chaikin power gauge rating for DaVita is very bullish due to very strong price volume activity, attractive financial metrics, strong earnings performance. The experts are middle of the road. But when we take the 20 factors, 5 in each of these categories, we get our very bullish rating. Strong trend, strong industry group, type of name we want to consider. It's a bit of a mixed bag here, right? We have a personality change at play as we go from underperforming to outperforming, and then the rating turns bullish. So this is intriguing. Stock is oversold. Stock is above a rising long-term trend line as it pulls back. There's support, call it in the 50 to 55 area. I don't love this little dip in money flow, but maybe a bit of a personality change. That's why I say it's a bit mixed. I think DaVita looks interesting. I think you can own it. I think it looks compelling on the long side as a bullish idea. But as always, I think you want to manage your risk given the market environment and given this dip in money flow here. But this looks like a pretty compelling name, a stock that's making the turn, had a bit of a breakout. Now it's pulling back to test the breakout level. If it holds at 55, I think it makes sense to be on the long side of DaVita. Ticker symbol DVA. Take a look at that one as a bullish idea today. Sector tracker now, looking at the movement of the major sectors over the last 5 days, all skewed to the bullish side. And as we've pushed to the top end of the range that we've been highlighting, or near the top end of the range that we've highlighted, sectors have turned positive. And it's interesting to see that the offense is now pushing. Discretionary and tech, a couple good days in a row, push them to the top of the list. And then underneath there, utilities and staples leading the charge for the defensive areas of the market. Industrials catching a bit of a rebound, comms and energy as well. Real estate towards the bottom of the list now, but still solid gains over the past 5 days. Healthcare, fins, and materials. Fins rebounding, but with that path of least resistance lower for rates, fins are going to have a tough time, in my opinion. At least the banking portion of it. You know, we've been excited about insurance for a while, and that's been a great area of the market for you to be focused for bullish ideas. Another great area to be focused has been aerospace and defense services. Over the past 6 months, the group has outperformed by nearly 7%. Power bar ratio, which measures future potential, is very strong. 14 bullish or very bullish stocks, only 4 bearish or very bearish stocks. Has moved down 1 slot over the past week, but still, in the top 3. Wesco Air, WAIR, AAR Corp, AIR, and Arconic, ARNC, all stocks with very bullish Chaikin power gauge ratings. So these would be what we would call leading stocks in a leading industry group. You want to look at these stocks when they are oversold with bullish money flow. And here's why. Look at this XAR. Right, SPDR, S&P, Aerospace and Defense ETF, very bullish Chaikin power gauge ETF rating, outperforming the market. The analysis works the same way, right? Bullish rating and outperforming. And notice the intensity of outperformance starting to tick back up here. Ever so slightly, you can see this line heading higher. Persistently bullish money flow since December. It's closer to overbought than oversold, but solidly above a rising long-term trend line. I mean, if this was a stock, we would refer to it as a classic bull. Leading industry group. This is where you should be hunting for long ideas. If you are hunting for long ideas right now, this is one of the groups where you should definitely be spending some time and focusing a lot of your attention. Taking a look at what's trending now. Yesterday's gainers and losers, our movers and shakers. Target up 20.5%. Following their earnings announcement, I noticed I caught a couple of upgrades here this morning. Lowe's solid print sent that stock higher by 10%. ADS still trading well following their tender offer, up 5.6%. Retail names caught a bit of a bid yesterday. JW Nordstrom was interesting. The stock was up over 5.5%. Yesterday in front of their print last night, where they then missed sales. So we'll have to see how Nordstrom trades today. And Kohl's rebounds after the drubbing that it caught following its earnings, post-earnings performance. On the loser side of the board, Aflac, AFL, some news out regarding improper sales of some of their policies sends that stock lower by 5.5%. Halliburton and MRO down with the still very weak energy complex. Continues to be an area of the market that we are avoiding at all costs. If that changes, we'll shift, right? We're not dogmatic in our view ever. MOS, no real news there to send the stock down by 1.5%. And ADI, Analog Devices, reported earnings, and that stock was down by 1.54%. Let's talk about it now. Let's get into it. On Thursdays, we look at market breadth in my note to Chaikin Analytics clients. So let's take a look at it here. Advanced decline line for the S&P 500 has started to move higher again after holding above the May breakout level. And that's kind of interesting to me. Why is that interesting to me? Because the May breakout for the AD line preceded the June breakout for the S&P 500. And the fact that the advanced decline line has been able to hold above that level is encouraging as a breadth metric for the market. Now, what I would love to see, and this is what we mean when we said they're not tipping their hand yet, AD line, I'd love to see it break to new highs. The advanced decline line can break to new highs here in the near term. That greatly increases the odds that the S&P 500 will do the same. So far, it's not there yet, but it's definitely something that we are keeping an eye on. And you should too. We look at it every week. Some of the other breadth metrics that we look at here, longer term trend perspective, kind of interesting. The percentage of stocks trading above their 200-day moving average has moved to 56 this week from 51 last week, actually 58, I apologize. And what we did is we went back and we looked at how the market performed over the ensuing 6 months when this metric is above 55, as it is right now, and the market is above its 200-day moving average, as it is right now. And it's generally bullish over the next 6 months. Higher 75% of the time for a median return of 5.41% rather. Now, if you're a bullish investor, though, you want to see this metric get above 60. That is a sign that a healthy majority of stocks are in long-term uptrends. For now, we're testing and holding support, and that is encouraging. A breakdown would bother us. A continued move higher, especially above the 60 level, would be a bullish sign for the U.S. equity market. And as we think about the 50-day moving average, looking at the shorter term, when we look at the percentage of stocks trading above their respective 50-day moving averages, we can see that it's moved up here to 43, 44%. It was down at 25% last week. But here, too, it's held support, right? Held support. So we went back and we looked at data going back to 1950 for instances where this metric was greater than 40%, but the market was below a rising 50-day moving average, which is the case right now. And the market's actually higher 3 months later, 77% of the time, for a median return of 3.28%. So the breadth metrics are starting to line up. They've improved. They've held. And you can see here the S&P 500 has held above support as these breadth metrics have done the same. That is an encouraging sign from a trend perspective for investors. Now, again, they're not tipping a breakout just yet, but this is what we'd be looking for to increase the odds that the market will break out of this trading range. Talked about ESG. It's a theme that continues to grow. DSI, the iShares MSCI KLD 400 social ETF. Again, this is I'm new to this theme as well. I've been getting a lot more questions about it, so I've decided to dig into it a little bit. So DSI, let's look at it purely from the technical perspective, is above a rising 200-day moving average and is holding above the breakout level here at $107. So that's encouraging. Similar to the S&P 500, the RSI is mixed, middle of the road, trying to get back above the 50 mark. But on a relative basis, looking at it relative to the S&P 500, it's in a consolidation now, but still that consolidation is within the context of a rising trend. So definitely something to keep an eye on for investors who are interested in this emerging theme, or actually it's not even emerging anymore. It's a growing theme of socially conscious investing. Take a look at DSI actually as a bullish Chaikin Power Gauge ETF rating. And finally, this week took a little bit of added something new to my note. Looked at the S&P 500 sectors. X-axis is RSI. Y-axis is percentage from their 20-day moving average. And you can see that the bond proxies, REITs and utilities, are extended. So what I did is I went back and I said, okay, show me examples of when a sector is more than 2% above its 20-day and RSI is above 60. When that happens, the sectors tend to underperform the S&P 500 over the ensuing month rather. But what's interesting, you might be saying to yourself, well, let's look at energy and financials. When they're this low, more than 2% below, and an RSI of less than 40, they actually don't outperform. So that's just an interesting dynamic. That wraps it up for today. We've talked about my survival guide. Go check it out. I'll see you tomorrow.